All right, welcome back to another Stock Talk live stream. I'm your host Jesse, and today we got Derek from Midas Investing. How's it going, man?
Hey, what's up?
Oh, it's been a fun couple weeks. That's for sure. With kind of narrative changing with the Fed and rates staying higher for longer, all that good stuff.
Is it a
It's been
narrative
pretty
change?
fun.
I feel like J-Powell's been saying that.
I I feel like
I feel like nobody believed him.
everybody knew that it was like going to uh, eventually I would say plateau probably around here, but I think people were expecting more of a quick regression from whenever they felt like they got stuff under control. So it kind of seemed to me that like even on the dot plots and like the bond futures, it kind of looked like people are now expecting, or the market's now expecting them to stay at higher rates for a longer amount of time. So like a slower regression off of those higher yields. But I don't know.
Yeah, I totally agree. I just kind of joking on it because it is funny that you could have just taken him for his word and everyone would have been less surprised. But at the same time, if you had taken him for his word in 2020 and 2021, you would be SUV right
Exactly.
now. So, uh,
Well, and that's the funny thing is that like, it kind of he says this now, but is something or what breaks and how far are they behind it in the data and how fast do they react?
yeah,
Right?
exactly. It's not that the
Because
people think he's literally going to change his mind. It's that they think that something is going to change and it's going to force his hand. Yes,
yeah.
but
Yeah. No, but it's been interesting to see a lot of different asset classes react to that. I know we've had kind of almost seems like multiple re-ratings in different industries, and then you also have like risk re-ratings on companies that have a higher debt and that are potentially at more risk now that if rates stay higher for longer, they might not be able to refinance out of that some of that debt. They'll have to refinance at higher rates. So yeah, we'll see what happens. The market's kind of throwing a little bit of a fit though, which is kind of fun. I don't know. I enjoy it.
oh yeah, definitely, definitely.
All right. So today I think we were going to talk a little bit about advanced auto parts, AAP. Um, and I don't know if do you want to go and do a full kind of I wouldn't say pitch, but like thesis breakdown on AAP, and we can just discuss it, or how do you want to kind of tackle it? I know I've looked into O'Reilly's, AutoZone, Genuine Parts Company, a little bit into AAP as well, but definitely not as in depth as I think you have.
Yeah, I can give kind of a quick pitch on it. Though I will say it's like I wouldn't even say I've gone that deep to be honest. There's lots of corners of the story that I definitely didn't cover, and I'm aware of that. So I almost feel like I have to say that before someone says, "Oh, well, what about this? What about that?" Because I actually did keep my I put a video out there on AAP or anybody who's watching, just so you're aware, you can watch it and see it. Um, where yeah, I basically did I guess you could say sort of a top down look at the major players within the space, particular O'Reilly's, AutoZone, and Advance. And then I also kind of compared that to a kind of theoretical rest of the other industry, which I compiled out of some aggregate data that I took from Aswath and Motoron's website. There is some problems with relying on that data. So that's one of the things what I say is like, there's things you can point to make your arguments about it, which is, for example, the companies that are in that group aren't all exactly auto parts companies. So I look at it as more of like a comparative of auto type companies and comparing the relative revenues and margins of that space to these other major players. But anyway, so getting with that though, I was essentially trying to focus in on like what makes advanced auto parts a little bit different than the other players. Because a lot of people, as we were kind of mentioning before we started a little bit, Advance is seen as the low margin player within the space. And I was trying to determine whether or not that was something that it's like permanent, or if there's some theoretical possibility for that to change, and whether or not that should be, the crutch of your valuation on it or not. Because I mean, in general, like a PE ratio is often some confluence between growth rates, net margins, and risk. Essentially, those are like the core components there. So net margin, if it's going to be the lowest net margin, you're probably going to see a lower PE ratio. This is why all the subscription companies have high PE ratios, typically have high margins. But yeah, so one thing I discovered, in particular, one of the biggest factors that I think really explains the difference in the margins between O'Reilly, AutoZone, and Advance in particular, is their share of the DIY market in particular. O'Reilly's and AutoZone are much more focused on the DIY space within automotive repair. In particular, in the last year, AutoZone had 71% of coming from DIY. O'Reilly's had 56%, and Advance had 41%. And those percentages ebb and flow, but are pretty consistent over the last decade. And so, I mean, put the margins up against that on a graph, and you can see the obvious correlation there. I think.
Yeah.
And if you look in AutoZone's annual reports, they they're super proud of this. They talk about this, and they actually give the exact reason why this would affect the margins, which is to say that DIYers are less regimented in their maintenance. They're less focused on like the regular routine of it, and it's much more of like when problems spike up, like when you have an issue, you're like, oh, I got to rush out to go get that part in order to keep my car running. Or the other end of the DIY is that you're a hobbyist, and so you're maybe looking for much more specific and custom parts and things like that. And so DIY is inherently going to be a higher demand space than the more professional section space. So Advanced Auto Parts, on the other side of things, is actually very proud of the relationships that they've built with professionals, which you could argue that that's just a clever way of spinning that. It certainly is. But I think there is some value, some argument to be had for some benefits that can construe to you. In particular, this gets back to the kind of other industry grouping that I was talking about, comparing the revenues of other auto companies within the kind of general retail automotive space from the aggregate data set. And those companies on net, when you take out O'Reilly's, AutoZone, and Advance, the rest of them, they've had higher revenue growth and higher margin growth since COVID began. And so part of my thesis a little bit is that I think some of that is unsustainable and was largely driven by a lot of the supply constraints. So like a lot of people might have wanted to go to O'Reilly's, Advance, and AutoZone first, and then maybe they were pushed to other companies a little bit because of the supply constraints. So I think there's going to be a little bit of a reversion in mean in terms of the distribution towards the major players versus some of the smaller players. So I don't think the DIY effect is going to change. That's not going to change at all. But I do think there is sort of a little bit of a game theory way of looking at the whole industry and seeing how some smaller players may not be able to sustain their growth that they've had in the most recent couple of years, strictly off of the back that they're not going to be able to maintain that same relationship that they've had going forward. And this could be compounded by some of the other factors we were talking about, like debt levels and refinancing situations, if some of those smaller players made some unwise allocation decisions there, though obviously that could be true for any of the larger players as well. The one other factor that I would say is like the kind of core to the pitch, which is one thing of why I do think the margins could improve somewhat, but not a lot, just somewhat, which is to say that there is another core difference between Advance and O'Reilly's and AutoZone in particular, which is to say that O'Reilly's and AutoZone both report their operating margins using GAAP FIFO, whereas Advance uses a LIFO adjustment, last in, first out, for their inventories. And this, I mean, their GAAP reported numbers are still GAAP reported numbers, but this does affect how they report their guidance. And so I do think that this has a big effect on the way analysts and the rest of the market would perceive them based off of that. And they are looking to slowly shift back to a FIFO reporting method for those estimates going forward. And for people who maybe aren't super aware on the differences with accounting, if you have a first in, first out reporting system for your inventory versus a last in, first out usually makes your net income look better and your inventory look larger if costs are rising over time, and then you get the reverse effect with LIFO. So I believe there is some reason to believe that margin improvement would come a little bit.
Yeah, that's interesting. Yeah, I did not know about the LIFO FIFO. That makes a little bit of sense with how they could potentially be trailing the other players with margins, at least from a little bit of a reporting basis. Do you think this was something that I've kind of thought of when looking at the multiple players or whatever? But going through COVID, do you think the lack of new cars led to increased used car repairs and almost used car parts demand at all? It seemed like, I mean, we're still pretty meh on new car inventory and new car production, which I think could help the used car parts dealers going forward for a little bit. I'm not sure it's going to be a huge tailwind. I could think maybe it's going to offset some of the demand that's eventually shifting towards EV vehicles, because those should have way less maintenance costs associated with them. But do you think in any of the research that you did you find any big correlation with the increase in demand being from just the inability to purchase new cars over the last 2 years or so?
Yeah, I did do some research a little bit in this direction. It was honestly one of the first parts of this that I kind of wanted to look into, is that because just the whole EV space just hangs over everything else
Yeah,
automotive like a cloud. And it's another industry that honestly I had generally been shying away from because of my concerns about my own lack of an ability to essentially predict what's going to happen there. I did find this one graph, which I gotta say is like, this is the graph I look at when I want to like feel comfortable about AAP, which anybody can find if they just search S&P Global vehicle age US. You'll find it. There's an article that S&P Global put out talking about the average age of vehicles, and this most recent article came out like partway through 2022, so it's basically as of 2021 mostly. But essentially, the average age of vehicles is like 12 years. For light trucks, it's like 11.6, and then cars, it's about 13. So there's a little bit of a spread between the different types there, and it's risen over the last decade. The overall average from about 11 to 12.2. So it's been rising over the last decade, and in the last couple of years, you can definitely see it rising
it's
faster
increased.
than the rest of the clip there. And so yes, there absolutely has been a huge increase in the demand for auto repair just because people haven't been buying more cars, whether for EV reasons or for supply constraint reasons, probably a confluence of both. And then, yeah, with like I said, I had serious concerns about like how fast is the EV space going to take over. I went and tried doing a lot of research on that as well, which for the record, in general, I've always been pretty skeptical of the timelines that have been put out about the EV revolution. So I definitely don't really believe that we're all going to be driving majority electric vehicles in 2030. Like I really just don't believe that from a materials perspective. It might be getting somewhere. Percentage will start to be climbing.
I think we
But
could potentially have over for 50% of new production vehicles being made could be
sure.
EV, but
We could reach that
yeah,
point.
they're not. It's not going to over 50% vehicles on the road being EV. That's probably not going to happen for 20-25 years.
Yeah, something like that. Yeah, because like and like I said, I'm talking strictly from like a materials perspective. Like it's like literally just the physical resources required to build the cars themselves and the rest of the infrastructure. And then the infrastructure, getting to that, is the thing that I was kind of looking at when I was trying to think about how is this going to affect AAP. When I was looking at that graph of the average age of vehicles, I was like, okay, so this graph in a vacuum with no EV space would basically imply that the automotive space is like going to kill it over the next decade. But yeah, how much of that is going to be taken up by the EV space? The thing that kind of I think really clinches it for me, you can look at it from lots of different perspectives. Like I said, you can maybe look at the materials, the mining materials, the metals that have to go into the vehicles is one way you can try to say there's huge limitations here. But I actually look at the power constraints as being one of the the biggest issues. They've done a lot over the last 5 years to up the charger presence in the United States. Like that is definitely starting to grow. In fact, essentially, if you scale the amount of power that's needed for each charge for a vehicle relative to the vehicles, it has essentially been growing at the commensurate rate that you would want it to relative to the growth of the EVs in order for it to actually start to take over. But the problem is that the power grid itself doesn't really have the power, in my opinion, to actually do that. It's like we essentially would need to like have a revolution in the actual electric generation here in the United States in order to actually even charge all these cars overnight. So yeah, that's my biggest hang up on that.
Yeah. And well, the charging infrastructure, the power generation, that's going to vary probably region by region, but yeah, it's going to be a huge increase as far as power consumption in general. So yeah, I don't think everybody's going to be getting a Tesla solar roof for 60 grand or whatever.
No.
But I mean, that does lead into like, other possibilities where you maybe look into like microgrid technology or something like that, and some type of advancements or technology that would help combat that in the future.
I mean, there are ways. I'm like super pro nuclear from like a just theoretically, do I like it kind of perspective.
Yeah.
I dream for the day that we have nuclear power plants powering everything, but the point is those take 10 years to build too. So,
and until then, what's like probably the cleanest, most stable form of energy production would be hydro, probably hydropower.
I don't really know too much about what would be how to necessarily think about that, but maybe.
Yeah, but no, hydro, like dams.
Hydro's pretty nice because it's just kind of already happening. You're just taking advantage of what's already there, but there's only so many rivers and stuff. So that's
and then people get upset about the salmon runs or whatever. So
then there's environmental concerns as well. Yeah.
It's funny because there's never going to be any type of energy source where nobody has a beef with anything. Like it's always going to be there's always going to be something that is I don't know, in contention. But I was going to say, if you have anything that you want to share, let me know and we can put it up on screen as well. If you have any graphs or anything like that.
I mean, I can try to find that. I can pull that.
No, it's fine. I just if you had it up, I was gonna say go ahead and share it if you'd like to. Let's see. Yeah, I did listen to several of AAP's calls, and the interesting part, I think they own, was it CarQuest? Am I getting that right? CarQuest is kind of their direct shop kind of brand, their professional brand, I want to say. But kind of the narrative they gave, at least on this latest earnings call that I listened to, was that they expected a pretty quick recovery as they got through some of their inventory and started making these switches to their newer generation of products via the CarQuest brand. So, and that'll be interesting because if that does happen, like the market's not pricing that in at all. I think the market's pricing in like a very, very, very tough road ahead for them. And unfortunately, I think they just did get their debt downgraded, right? So they went from investor to junk grade, I believe, and which flows in perfectly with what we were talking about before. So not only if you're a company and you have debt that you're going to look to refinance, but then rates are now at 7.5% or 8% instead of 2.5, 3%. And then you got a downgrade on your debt, your credit rating. So you might even have like a higher interest payment if you have to refinance those rates. That would be a pretty interesting thing to look into as far as their debt stack goes and when those maturity terms are coming to date.
I actually had pulled up the maturities because I sort of knew that was going to be a relevant question to answer. Yeah, and that's the thing is like I think their maturities are better than they could be. They could definitely be better always, but it's definitely not, it's definitely
But they're
not
not
next
horrible.
year. Yeah. Yeah, so let's see. Long-term debt. We got like 400 million almost due in late 2027. Then we got almost 500 million in 2030, 350 in 2032. A revolver that it does have to be revolved at the end of the year of a little under 200. So that's the smallest chunk there is on the revolver. That's good. And then there was also some leases as well. Kind of evenly spread between 2023 and 2027, about maybe 400 million for each of those. So yeah, it's like, maybe that's like a billion that would have to be rolled over within the next year, over compared, which makes up maybe about 20% of the overall stack. So
Okay.
if we get lower rates by the end of 2024, I would say it's not the end of the world.
Yeah.
But maybe
And
if
did you
we're
say
still in
what that
2025, that would be starting to get painful.
did you say what that debt was currently at? What rate that
Uh,
debt was
oh,
currently
the
at?
rate. Yeah, well, those are definitely different rates, but I can kind of give you a brief average. Let's see the all the leases are discounted at about 3.5%, and then the actual maturity debt, the bonds, we have 1.75 for the 2027s, 3.9% for the 2030s, and then 3.5% for the 2032. So that's in the right order. The most recent debt is the oh wait, no, that's actually the opposite order. You would want that. You would want the lower debt at the longer maturity. But nonetheless, if you have to pay back depending on premiuming and discounting, then that could actually be a benefit.
Yeah.
But yeah,
Yeah.
so it's like they definitely have a lot of debt. But I think it's in a better situation than it could be. I'm not going to call it great. Definitely not going to call it
Yeah.
great. But
Yeah. And from what I've seen, they've sounded like they're making more of an effort to attack the DIY market, especially like online ordering, online DIY orders and whatnot. Do you kind of get the same impression from them as far as going after that market a little bit more?
I get the impression that they talk about it, but I definitely wouldn't really take that as any sort of
Yeah.
path until I see it. Yeah, it's like
Yeah.
I they like I said, it's like in some I think they kind of shifted their tone almost a little bit in a couple recent calls, maybe after being asked about it enough times. But uh I've heard in other calls where they were kind of proud on the other end of it, where they were like, "Oh, we have built relationships with the professionals." I was saying like that's like the way they were spinning it. They're like, "Oh, we don't have the DIY, we have the professionals."
Yeah.
It's like that's better. And it's like, yeah, you have less bargaining power with those
Yeah,
professionals. That's
yeah, exactly. So with DIY, like I pretty much do all the work on my cars. But the way I like to think about it is like DIY is like the retail sucker. Like
yeah,
that's the person that is like in their garage at like 11:30 p.m. and it's like, oh shoot, I need this thing or whatever, and like you're running out, trying to catch the store before it closes, and you don't really give a crap how much it costs. Like if it's $5 or $10, like or $40, whatever. It's more about just being able to get that somewhat quickly and local to you. So yeah, I don't know. Like I think I know AutoZone has done a good job at that DIY market, and which is funny because I always thought AutoZone was crap. Like that was like one of the lower places on my list. I'd usually go to Napa or O'Reilly's right away, and AutoZone is always kind of like last on my list. But man, they hit the DIY market so hard with marketing and whatnot, and established a really good presence there. And yeah, they got the margins to show for it now. But yeah, I don't know when the last time, and I don't think they're as popular maybe in the Northwest, but I don't know the last time I've been in an AutoZone. I did do some like website comparisons as far as just like ease of use for shopping. And Advanced Auto Parts did have, I would actually say they had one of the easier systems to use for common like repair jobs. Like if you're doing like
Hmm.
brake rotors and pads and stuff like that, you like put in your car and it's like super like click, click, click. I want this done. So I was actually pretty impressed with that from like an online ordering perspective, but
Hmm.
it they didn't seem to like on the price when I priced them out between the different vendors I usually use. It was like meh. Like I didn't really get like it didn't seem like it was a crazy good value. In some cases, it seemed like it might be a little bit overpriced or a little bit expensive, but it also depends on the quality that you're getting as well. So maybe I'll have to use them a couple times and see what I think.
Hmm.
But
Yeah, interesting. Yeah, I'm definitely not a big auto person myself. So yeah, it's like I've probably been in any of those stores twice in the last like I don't even know how many years. And
yeah,
I feel like the ones that I've gone to basically all times I can really remember most recently probably was AutoZones.
yeah,
But it is often just me kind of like Google mapping which one's the closest, and not
yeah.
necessarily uh,
It's the
thinking about the brand.
convenience.
Yeah.
It's the convenience. And then like once you go once or something like that, like
Oh,
it's
and I would have been
you're
living in Massachusetts at the time, so that would have been East Coast kind of
yeah,
that
you're
gave
more
me that.
likely to go again if it's close and convenient to you, that'll be your probably go-to. Um and I like AutoZone wasn't horrible. I just didn't like the quality of the stuff I got, honestly. Like the two times I went there, I just thought it was like really crappy stuff. Um but yeah, whatever. Um, but yeah, here's the this is the graph that you were actually talking about for the age of vehicles um over the
Yeah,
years. And
this
yeah,
chart
it's
just
we
smells like opportunity to me.
yeah, man, that's good.
It might be
I
opportunity
wa-
for the EVs. Like I said, it's somewhere in between because it doesn't say what these people do with these old vehicles. It just says at some point or another they need to be either repaired or replaced.
yep. Yeah. Well, and there's going to be a long time before I think we're going to see a lot of hybrids for a while too. Um, Full EV platforms are starting to get more standardized. I think like Chevy is really releasing their EV platform next year. Um, but
How
I
many more
think
hybrids have been coming out lately? I feel like I haven't heard about hybrids like at all for a couple of years.
they don't really get mentioned, but basically that's almost like what I see happening is like the new normal is almost like a hybrid as your base.
Yeah, I mean that
Like
makes a lot of sense to me. It just suddenly occurred to me. I was like, wow, it feels like ever since 2020, everyone just flipped the switch and was like, no, full electric.
yeah,
When before that, it actually was kind of the hybrid, you know,
Toyota
world.
Toyota is very very heavy on slowly developing their hybrid line. So they're still doing lots and lots and lots of hybrids. I think they might only have one full EV, and I don't think they're going to go full EV until they can really produce EVs at a price point that fits their customer base. So I think for a long time we'll see like Honda, Toyota, Kia, Hyundai, um, probably playing a lot of the hybrid game, and that's going to be kind of like your standard entry level vehicle. Uh, I, I mean, I think for EVs to like really replace the standard entry level, you've got to get like a brand new EV down to what, like 20, 25 grand
Yeah,
unsubsidized, right?
yeah.
So, and that's probably still a ways off. But with that being said, like with how quickly technology improves, if they make a major breakthrough in like battery technology, because that's the major cost is just the
Mhm.
batteries, right? If there's a major breakthrough in battery technology and they're able to get, like double the capacity at the same amount of cost, or like half of the cost for the same amount of capacity, either way, that could be a humongous game changer as far as how quickly EVs could be really adopted.
Yeah, definitely. As I was kind of mentioning the material constraints, yeah, a lot of those mining constraints do hit it in the battery materials in particular,
Yep.
the nickel and the lithium and the titanium. Though I don't know if you heard the news a couple days ago. There's some gigantic deposit of lithium that was supposedly discovered here in the U.S.
Oh,
Um,
really?
yes, early
Elon's like,
estimates.
let's go.
Yeah, but early estimates. So it's one of these things where it's like they have a number and it's like a huge number and it's like one of the largest deposits on Earth or something.
Oh my
But
gosh.
this is like an early survey, probably not an accurate estimate once they get down to it, is like how much of this is economical and all that. And
Yeah.
then the other part of the equation, I don't know how much you've ever paid attention to the mining industry, but I have looked at and dabbled a little bit there. But the United States is one of the most expensive places to try to mine things for a million reasons: labor
Oh yeah.
costs, environmental, everything. Generally, the more developed your nation is, the harder it is to mine there.
We don't have child labor. No.
Yeah, you're just not willing to let all the bullshit happen that's gonna make that
Yeah.
cheap. Yeah. So yeah, there's a lot of things that can prevent us maybe from capitalizing on that deposit. But supposedly there was a huge lithium deposit discovered this week.
That's
So
interesting. Yeah. No, I know. I think I've heard some stuff about Toyota. Toyota making progress on their solid state batteries as well. And yeah, there. If
that could be
one of these
interesting.
players can make a breakthrough and you can get like a 500-mile range out of a battery, like that's going to be at a decent cost. That's going to be really, really big.
Yeah,
But
they really just need to invent a new battery. Yeah, it's like there
yeah,
needs to be something completely different, not just tweaking the current model.
well, and it's hard because not only do you need the capacity, but you also need the charge rate. So like
Yeah.
asking for all of these things on top of each other, it becomes very, very difficult. Um, so with AAP, what's your valuation kind of looking like on this one? What are your price points of interest on it?
Let's see, got my valuation up here. Um, well, I what I usually do with my valuations, I have like kind of a general expected value. You were talking about kind of different scenario analysis that you do with your valuations. I kind of do something similarly, but mine's definitely very, very complicated. My valuation template, I actually essentially compile over 1,000 different valuations that are slightly tweaked along
Okay.
many different variables, and then I create like
Okay.
a distribution of all those values. So like
What is it called? Like a Monte Carlo? Are you?
it's kind of
Is it
similar to that, but it's not actually running any sort of simulation. There is no actual Monte
okay?
Carlo. It's more like a Bayesian probability
Is it
engine more than
like
anything,
that
because like
kind of
I'm
thing?
assigning the probabilities, I'm assigning the distributions to all of the variables, but it is trying to create a Monte Carlo distribution looking thing. It is.
Interesting.
It's like I kind of came up with the idea after watching Professor DeMonaron use Monte Carlo
Yep.
simulations a bunch of times, and I was like, "Oh, this is so cool!" And then I tried looking up similar programs to do that, and I was like, "Oh, these cost a bunch of money." Okay, and I was like, "Well, what
Doesn't
can I
he
do
have
that's
like? Doesn't he use like an Excel plugin that
yeah,
like auto runs the entire thing?
yeah, it's called Crystal
Yeah.
Ball, and yeah, I'm pretty sure it's like $200 a month or something to get that one or something. And then like his students at that
Jeez.
school get like a free access to it while they're students. So I mean, I wish I was a student there, but yeah,
Yeah. Dang.
I see one of my viewers threw a comment in the YouTube chat. I figured I'd comment on it before we did just dip away from it. So what do you think about this new CEO pick coming from HD Supply? I kind of like where he's coming from. We'll see how well he sits in a top CEO role versus just a subsidiary CEO role. But the idea of coming from like a distribution center based subsidiary, and particularly around Home Depot, which I think is one of the best
Yep.
managed specialty retailers in the country. So I'm honestly somewhat excited about the pick that they made. But at the
Yeah.
same yeah.
He seemed to say all the right things, at least on the call, but that can be like easier said than done. But yeah, it's pretty interesting. So he's actually the new CEO then?
Yeah.
Okay. Because man, on the call that I was listening to, it was like it almost seemed like he was like in an advisory capacity or something, or like he was just coming on and like wasn't actually established in the position yet, or
Oh, well, yeah,
something crazy.
I think maybe the official date hasn't rolled yet. Yeah, so
Yeah.
like on that call, Greco, I think, was still the CEO.
Yeah,
Um,
because he wasn't leading the call, but then they like referred to him like over and over and over again, and they're like, "Well, this is why we're bringing this guy in. Well, this is why we're bringing this guy in." I
yeah,
was like, "All right."
I had the release they put out. I pulled it up. I tried to pull up like everything I thought we might cover before the discussion. But yeah, it says that it was effective September 11th. So if the call was
Okay.
before that, which I think it was,
Yeah.
then yeah, Greco would have been technically leading the call.
No, it seems like a good pickup, and I don't know, was he in a C-suite role at Home Depot, or was he like, I want to say he wasn't. I want to say he was like a VP or something like that. I'm not sure if he was. Uh,
Well, to the top level Home Depot enterprise. Yeah, I'm not sure if he actually had a seat at Home Depot specifically, but he was the CEO of the HD Supply subsidiary.
oh, okay, okay,
Yeah,
gotcha.
so which is a
Yeah,
pretty big chunk of what they do. But so it's like,
yeah, yeah,
but that is essentially it's like no different than just being a department head, effectively speaking, to Home Depot.
yeah.
Um, so you kind of look at it both ways. It's like he technically sort of got some CEO experience, depending on how much independence he was given within that space, and we don't really know how much independence he necessarily got on a day to day with that.
Hmm.
But yeah, so it's
So,
like on
sometimes,
paper, it's good,
sometimes I find it hard to like assess that because you're always trying to figure out like, okay, how much of the change did he actually influence? Like how much of that was actually him leading and pushing most of it versus like maybe just the people around him.
but
Um but no, from what I heard, I was pretty excited about that. It seemed like a really good fit. It seemed like something that they really need to focus on. Gaining a lot of efficiencies in their supply chain could help and go a long way. And then, man, if they're able to do that, like it, it is just so cheap right now. Like it's so cheap.
yeah. So getting back to those price targets, I didn't say anything about like kind of
Yeah,
stuff.
yeah. Go ahead, man.
Yeah. So anyway, I described the distribution thing so that I could make it clear that when I usually kind of say, here's some targets, I actually usually say, here's the first quartile, the median, and the third quartile to the distribution that I made.
Okay.
So yeah, I've got around $66 as the first quartile price right now, which that
Okay.
means that I see essentially 3 times as many outcomes to the upside as I see to the downside if you were to buy it at this price. That's kind of the implication there.
Yeah.
Because like I said, it's not real probability, it's just numbers I made up. So it's
Yeah.
essentially what's in my head out of all the things I was able to come up with in my head and put into this 1,000 different valuations, the
And
about 3 times as many are to the upside at $66.
so that $66 number, is that a projected future fair value or is that like a current fair value?
That is a current fair value. Yeah,
Okay.
I generally yeah, because I've seen your graphs a little bit, and you do a kind of a forward projection off of the present value to a future value, which I often talk about in some of my videos. I used to include a number like that in one of the older formats that I created. I used to include a 5-year forward value projection. And I always referred to it as a value projection because it included dividends, and I never wanted to make estimates about like what payout ratios they were going to do. So I was like, okay, this is just
Mhm.
going to be the total return, including dividends, that you'll get if you hold it for the next 5 years. But yeah, now I stopped kind of showing that number. I usually just focus on the fair value and then include an expected return, an IRR, or however you want to think about it. I actually personally use something closer to a yield to maturity calculation than an actual IRR myself, but they're kind of similar.
Okay.
But
Yeah.
yeah, fair value. I think it's worth. I think one, like I said, that's actually the first quartile. So that's not even really like the fair value as an average of all the outcomes. Then it's like my actual average, the expected fair value I have is actually more like $89.
Yeah. Yeah. Man. Yeah. Yeah. Oh, it's interesting, and it'll be interesting to see if they turn this around, how quickly it moves. Because this might be one where I just sit back and watch and keep up with the quarterly calls and whatnot. And once I start to see that momentum shift, maybe get in it at that point. At the same time, because the only thing I can think of is that like the market is pricing this for like death essentially. Like
Mhm.
it's really really rough. I mean, what is it down from almost 250 to $50?
Yeah.
Like it's just that is insane. Um
Yeah. And whenever I actually make a video on a company versus just kind of adding it to my list of companies I've made values on, I'm usually a little bit more hesitant to adjust the numbers I put in there because I kind of want the number that I had in the video to be there for as long as possible so people can see it. But the point is,
yeah,
I do usually come back around to my valuations every few months or something. If something's really sticking towards the top of the list or something, I might be like, okay, maybe I was being too optimistic here. Do I need to double check anything? Have the
yeah,
analysts changed their numbers a little bit? Yeah, it's like stuff like that. And so admittedly, I do look at AAP and I'm like, I don't know, maybe I need to come back around in a month or two and really double check to see if they're hitting my estimates. But at the same time, it's like I feel like I was, because like I said, I do include some margin normalization essentially in the number there. Their margins have been declining over the last couple of years, and as I kind of run through in those things, I have reasons to believe that it's naturally supposed to be improving, and that the decline was somewhat related to some of the like that just tiny little dip down in the most recent year. Not even a whole lot, just a little bit. But I feel like that's partially, like I said, just the other companies doing better next to them, and that some of that might normalize a little bit. And then
yeah.
there's multiple revisions as well and other things that can come with it. So it's like, yeah, I one thing I do think I made one mistake in my opinion with AAP, which is that I think I built into my allocation of it too quickly. Uh,
I was gonna ask you about that. How do you go about building out a position or staggering in? How do you
uh,
kind of think like that?
yeah, I have a pretty complicated process. Everything I do is like super methodical, and I try to have like a whole process, formula driven process for like everything. I almost try to like uh yeah, automate everything to a certain extent,
Yeah,
or not everything. I try everything but the actual thinking. That's the thing. It's like try to make it so that all I'm doing is actually doing like thinking. But yeah, so I have a pretty top down system for how I allocate companies, um, where I first and foremost try to determine what I think my appropriate cash position should be.
mm,
Um, and then from there, I make that decision essentially based off of how overvalued I think the market is and how overvalued I think all the companies that I've analyzed are, because those are the real market that I'm actually buying from, and how overvalued I think my companies are if they are too. So I kind of like weigh in all those things into determining how much cash I think it should hold, and then whatever
interesting.
percentage is left there, I then divide amongst the different companies. But I've changed my allocation system a lot over time, and I know I had mentioned earlier that I've been focusing a lot more recently on a little bit more of growth oriented plays rather than just pure value oriented plays. That's one factor that I've recently changed a lot with my allocation system. Is I've kind of now grouped all of my companies into four categories based off of what their volumes are doing. Not just the revenue. It's not about the revenue, because I honestly don't care if the revenue is growing if it's all coming from pricing. Um,
Yeah,
that's not growth. So yeah, it's like I'm specifically trying to focus in on what the volumes of the products and services my companies are doing, and then I essentially decide, are they a growing company, a shrinking company, and then the other two categories I have as cyclical and flat. And so I'm kind of treating all four of those as like a certain base allocation size that I would be willing to allocate to those different types of categories. Because I'm now trying to shift my portfolio towards focusing much more on volume growing businesses.
Interesting.
Yeah.
Yeah, I've always had a hard time holding cash, man. I'm like I'm until
That's
now,
probably good.
like what was that?
That's probably good. Most
I
individual investors have too much cash, actually. So
typically I would just be like, I'll throw it in the index, don't even think about it. Like and once you build up enough, it's like, yeah, like you could have well, definitely have a source of an emergency fund, right? Obviously, like I'm going to say, like for me personally, I want to make sure that I have some type of liquid assets that I can easily liquidate in the event of emergency. But
yeah, well, I
um,
should say when I'm talking about my cash position, that is not an emergency fund. Yeah, I was like, what?
yeah,
Yeah, yeah, not the same thing. Yeah, have emergency cash. Period. End of story. One way or the other. Otherwise, you're not going to have a portfolio for very long.
nope, nope,
Because you don't know when you're going to lose your job. But yeah, I mean, I'm talking about, yeah, just a cash position though. I
yeah,
mean, I
yeah,
literally look at cash as a position that all portfolios should have,
yeah.
even if you think it should only be 1%. That's
Well, it's a lot more tempting now since you have pretty much money markets paying 5%, or shoot, you can do short term treasuries or uh, what tips. Like, man,
yeah,
there's a
you can
lot of
play with
really
those.
attractive options out there.
Yeah, yeah.
That's for sure. How much? You don't have to say, but how much percentage wise cash allocation do you usually tend to have? Because that's
Well,
always interested me.
it definitely moves around a lot, and moves around a little bit more recently because I've somewhat been experimenting with some alternative types of strategies that are less appealing to the usual and value investor. But
You a trader? Midas trading?
well, I mean, I'm not really. I wouldn't label myself as a trader, nonetheless. But I have been doing a little bit more of short term buying
Yeah.
and selling with indexes in particular. Um,
Okay.
under certain constraints, and it's partially the whole purpose of it is to essentially try to limit the amount of cash that I'm holding on hand. That it is essentially trying to have my cake and eat it too a little bit. um
Interesting. Okay.
yeah, but like I said, it's an experiment though, so it's something
Okay.
that I'm kind of monitoring separately and not married to that as a strategy at all. But the way I look at it is like I've never really done too much trading in general, and that's because I do believe that long term investing is the route for most people. But I'm not going to look at all traders as a whole and do this whole you're all going to lose your money type thing, because no, there are some
Yeah.
really good traders out there. There are traders out there that beat the vast majority of individual investors
Yeah.
continuously for decades,
No.
for their whole
And I
career.
mean, if
There's not a lot of them compared to the
if you
losers.
figure it out, yeah, like if you're in that like
It's harder to
0.1%
be a
or
good trader.
whatever,
Yeah, it's like
yeah, it's if you can be consistent, like I mean, you'll make a ridiculous amount of money. The reason you never hear about it is that those guys like usually don't talk about it, and everybody that talks about it usually sucks at it. Like,
yeah. See, like Fuhat just mentioned in the chat, he was like asking about how my short long thing is, and that's kind of I think what he's referring to. It's like I have a large position in VU, and I've created some volume momentum indicators that I pay attention to that tell me essentially when I think over the next day. It's a 1 day horizon based off of what the indicators tell me at the end of the previous day of whether I
okay,
want to be long or short the index the next day. And then
mm,
it's not just long, because I sort of look at as long as like the default. It's like markets typically go up.
yeah,
So I actually, it's three positions. It's long, super long, which means leverage, and short. within that one position. I should say, like I said, it's an experiment. So I say leverage,
Interesting.
I say short, but even when I am in those positions, I actually have more cash than the leverage I'm using in that one position. So technically, my whole portfolio isn't leveraged.
Isn't leveraged, yeah.
Yeah, my net leverage is still less than 1, but I am experimenting with a little bit, a relatively short time horizon thing, where I guess you could say I'm experimenting with the idea that I might be able to predict some of the worst days. That's kind of the thing. It's
Interesting.
like I may not be able to predict. I'm not going to be able to predict every down day. I'm not going to be able to predict when every up day. But I think I have at least maybe dialed in on the ability to predict when a particularly bad next day is coming.
Are you looking for like momentum exhaustion?
Yeah, specifically, I'm looking at the ratio between mega caps and small caps, between high beta and low beta, as well as the ratio between the VVIX and the VIX, which the VVIX is the VIX of the VIX, so VIX squared.
The
I
VIX
guess
sticks.
yeah. So yeah, those kind of do two different categories, two different ways of kind of looking at it. It's like the the dispersion between the mega caps and the small caps lets you know when there's high concentration. The high beta and the low beta, and particularly like the direction it's moving in the concentration, lets you know like the kind of risk on behavior and like a bit of the flight to safety kind of preferences in the market at that given time. And then the VVIX to the VIX gets you an idea of complacency, because it lets you know essentially like how complacent the option markets themselves have been. So how poorly are people's hedging probably at that moment in time. So like that's kind of like the theoretical look at it. But yeah, like I said, an experiment, definitely a totally different direction.
You'll have to keep me informed on that one. I'll be a curious spectator, but interested from the sidelines.
Yeah, that's the thing. It's like I'm a very in the camp of value investing all the way. Warren Buffett, he's the go. Everybody, all the truisms everybody says. But at the same time, I'm the type of person that's like, well, do we know this for a fact? Why don't we try this? Why don't we experiment
Man,
with that?
You just gotta be a turtle trader, man. Just make your billions that way and call it good.
Oh yeah.
That's a wild story. Another, so I think two other questions I had in my mind, and then if you guys viewers have quite any questions, drop them in the comments. I'll try to keep an eye out, and we'll try to answer a couple of those questions before we finish this. But I was going to ask you, what is percentage wise, what would you consider like a core or large allocation for yourself?
I would say I would call something kind of core when it's over 5%. And then large is over 10%. And then kind of in between there's kind of the sweet spot where I generally want things to be. Yeah.
Nice.
That sounds about right.
And
like
then
I would say my average position size right now is 3.8%. So I actually do have a pretty significant amount of more auxiliary positions. But yeah, I generally try to get them up to that point.
Nice. So do you stick around, what, 30 holdings or so? 20, 30 holdings?
Yeah, usually around 20.
Nice.
Yeah, I got 19 right now. But I think that 19 does not include the SPY position as an actual position. Because I kind of just consider it like a liquidity strategy, essentially. Like I said, it's sort of supposed to be like a cash replacement in a way. But
yeah, I've almost come to the conclusion that like I pretty much only hold SPY or like VTI for my indexes, and then like if I want to be overweight something because I think it's an opportunity, then I'll overweight it. But other than that, like I'll just dump everything into VTI, and then I'll have my individual stock portfolio that I'll try to gain additional exposure beyond to whatever the SPY is allocated at, or VTI is allocated at. So are there a handful of companies or maybe a top 2 or 3 companies right now that you're interested in or that you think
Um,
are super intriguing, extra intriguing?
yeah. I mean, I sort of have like the what I kind of refer to as like the big four right now. Like I have like four ones that are, and this kind of relates to, as I was saying before, I have kind of like the different buckets that I'm putting my investments in now, and so like these four are all part of that growing volumes bucket, which is definitely part of the reason that they're the ones I'm focused on. And then with my allocation system, they're the ones that say I should have the largest allocations and that I'm the most under allocated to currently. So it's like that's how it's definitely driving the regular purchases. Um, one that we kind of already had talked a little bit before the show, which is PayPal. I've definitely been long PayPal for some time now. Another company that I do have a video out. And in fact, all four of these companies I have videos on. So if I'm very interested in it and I think it's a great opportunity, I probably have a video on it. I probably didn't just let that go under the radar. Uh, but I sometimes have positions I didn't make a video on, so that's not necessarily like I always have one. But yeah, PayPal. I look at them as somewhat similar to the AAP situation. They're very different in other
Mhm.
ways, but it is a super negative sentiment stock uh, in ways I think are just incredibly unfair. Um, they do have some real questions about the overall long term sustainability of certain parts of the profit metrics to their industry. As we were talking about, the whole payment processing space is kind of just a race to the bottom. And then there are other larger, more dominant payment processors, such as the Visas and the Mastercard. That while companies like PayPal, one of the things that people really like about them is obviously they were one of the earlier adopters to the more internet space, and so but now that's everybody does that. So it's like that's not special for them now, but they do have all these other features. Like PayPal has done a good job of pulling in a bunch of other like side services, wallet services, refund services, being able to use your credit card points at different websites, all sorts of like random little features that they've kind of added in, that I think have made them do a really good job of maintaining their presence alongside smaller players, because payment processing is definitely the type of industry where you usually see huge network effects. And so
Mhm.
being the third or the fourth is not a good choice. You can maybe argue and get away with being number two, and being like, oh, well, we can get away with being number two because everyone wants an alternative. But you don't need that many alternatives when it comes to network effect type things. Um, but one of the things I think PayPal has especially done a standout job of is broadening the overall types of merchants that they work with. They have a huge presence across the vast majority of pay windows in North American websites. Like a huge presence across it. Even small websites that don't do a whole lot of volumes, and that's the thing that a lot of people who are more not as bullish on PayPal might point to. They're like, oh well, they're not doing so good. Maybe in some of the bigger places where larger volumes are, but the internet still is going to have a whole lot of small websites, and by building
Yeah.
that relationship, it's like people get used to using PayPal, they're going to keep using PayPal. It creates that network effect. If you go to a random person's website to buy their merch shirt or something, they might only have a PayPal button. That might just it's either put in your card information or hit the PayPal button. They may not have an Amazon button. They may not have an Apple Pay button. So um, I definitely just look as PayPal has just more skies to grow. It's just a question of how high are those guys. It's not a question of whether those guys are coming. And then
Yep.
another new CEO for this one, though I would say probably more untested in some senses. He was at least in a somewhat similar space in some regards, but not quite in the same way as the Home Depot supply guy coming from another very similar type of retail position to a similar retail position. So I think that this CEO switch maybe has a little bit more to prove, considering it's a technological space where you really want somebody who really knows what they're doing.
Yeah.
But I just think that the revenue growth rates that are almost for sure a given for PayPal, I think, to at least a minimal level, just helps buoy the valuation even more than say like an AAP.
Yeah. Yeah, they've been pretty dang consistent too, as far as their growth rates.
Yeah.
But yeah, man, I think if I had to choose one between PayPal and AAP right now, I'd definitely go with PayPal. Um, but yeah, it's man, I I was telling you this beforehand. I feel like I just need a better understanding of the space, and it's one of those things where I do believe the space is going to have overall like tailwinds, and they'll be able to grab market share. Well, not necessarily market share, but they'll be able to grab growth just from the overall industry tailwinds. But I just do not know if I think for this to make sense, they not only have to grow, but they have to maintain some type of competitiveness in the market to where they are that like number two player, or like they're considered one of the more, I don't know, premium players. Because if they aren't, then I don't know if the multiples will ever kind of reflect um potentially an area where you could get like good price appreciation long term from it. Um, but with that being said, like it is like let's see where they it is trading at extremely discounted multiples from it has been where it has been in the last 10 years. It's just, is that going to be the new norm, or are they going to bounce back from this and they'll have kind of multiple normalization and they'll recover from that. So yeah, it is definitely an interesting one, and it is getting, man, under $60 now. That's crazy.
Yeah, I would say when it comes to multiples, like I usually in my DCFs am pretty conservative about the type of terminal multiple implied that gets thrown on there. I mean, I use discount rates and growth rates, period, but I at least create a distribution of what the implied terminal multiples are as well. They
Yeah.
come out of that because people usually like to think in those terms. But yeah, so it's like if I'm looking now and my weighted average terminal multiple assumption for PayPal that I'm applying is a little less than 20, like 19 point something. So it's like, which I would call that a pretty rich terminal multiple. In
Yeah.
my opinion, terminal multiples should be pretty low, uh, like lower than what the current S&P multiple is.
Yeah.
Because most that like the point of a terminal multiple is that you're already past the major growth stages. So you really shouldn't have a multiple that implies a huge amount of growth. And if there's no
Yeah.
growth on there, that means the other implication is you're using a
It's
super
like
low
your
discount rate.
it's like your steady state inflation. Like
Yeah, it's like
right.
if your company was going to basically, yeah, grow either at inflation or possibly even less, maybe even maybe even negative for the rest of forever. Yeah, it's like less than inflation, possibly zero. What multiple would you put on if it was going to grow at zero? Um,
Yeah.
and so it's like I would argue that yeah, I am probably putting a little bit of a rich multiple on my PayPal valuation to a certain extent. But it's not even that it's a little bit of playing with the concept to a certain extent because I don't think that it's necessarily that when it is in terminal state it's going to have a 20 PE. It's more like I have really high confidence that it's going to re-achieve that PE somewhere in the interim as well.
Exactly.
And so I'm trying to
Exactly.
at least capture for that a little bit.
Because
Uh,
your 20 PE is essentially what, like
that's
it's
after,
a 5% yield,
yeah, yeah,
5% yield on market cap, right? And that's essentially, yeah, I mean, like historically they've been trading, anywhere from like 2 to 3.5% or so. So I mean, a 5% revision to almost the mean would be pretty pretty that's not like crazy bullish, at least from where it's traded in the past. And
no, yeah,
especially if the market's assuming that this is going to be a fairly steady revenue stream, like that's probably that's pretty easy to come by that, I think.
yeah. And then usually how willing I am to be more rich on the terminal multiple side of things usually has to do also with the balance of how conservative I think I was or wasn't with revenue growth rates and margins as well. So I was like,
Yeah.
I think I was very conservative with PayPal's growth rate potential. Like my expected 10-year COGR is 5.3%. So it's like I'm basically assuming that they're going to grow not very fast at all for the next decade, and I highly think that they're going to outperform that.
Yeah.
So it's one of these things where it's like, well, where's that 20p going to come from in the interim? It's going to come from the outperformance. That's where it's going to happen, is that they're going to beat their revenue estimates and the market's going to push the multiple up, at least short term.
Yeah.
And that might create the exit opportunity possibly.
Yep. Buy
Yeah.
buy the fear and sell the greed, right?
Yeah, much easier said than done.
Much easier said than done. Just gotta look for the next meta, right?
Yeah. It's like I always buy too early and sell too late. So
buy too early, sell too early.
well, I mean, that's better.
Oh man. So let's see. Foo Hats. Random question. What's your take on Intel spinning off this new business? I don't even know what you're referring to, my man. Do you have any idea?
I don't either. I held Intel for a while, to my chagrin, and then sold out of it and didn't want to look at it since. So, so if they have announced anything in the last,
well, it wasn't a good hold a while.
No, but it was definitely that I was making poor over optimistic estimates back in 2020 with low interest rates, and multiple revision destroyed.
It was a growing opportunity, a personal growth opportunity.
Yeah, exactly.
Yeah, well, everybody has at least 20 of those, right? Like,
yeah.
Oh man, no, Fuhat, I have no idea. Intel spinning off Altera, no idea, man. I wouldn't be able to say much of anything right now, honestly. With that, and my mouse died again. Great, but cool. Well, we're coming up on over an hour now. So, guys, if you have any more questions, go ahead and throw them in the chat. Also, I did link to Midas's channel in the description. Be sure to check out his channel and his videos. Like and subscribe to both of us if you aren't already.
If any of you are my viewers, make sure you subscribe to him.
Thanks. And as always, none of this is financial advice. I don't know about you. I'm pretty sure you're not. I'm not a financial advisor. This is all entertainment and just discussion purposes only. Giving our thoughts on the market and different individual stocks. And yeah, don't take advice from guys on YouTube.
Yeah, I always kind of laughed at your little tagline you have in your thumbnails about that. It's like another subpar stock evaluation.
From
come on, man. You gotta value your own work more, I think. Come on, man.
Dude, I was not sure if I was gonna do this or not. Like, I kind of wanted to do some YouTube videos, even if it was just for my own tracking, because I was like, man, I know I'm gonna make mistakes, and like I want to like refine my process and everything. And it's just good to like, there'll be some times where I'm like, oh man, I did a video on that company. I need to go look at it again, because now that company is falling into my buy zone. I need to refresh my mind on what I was thinking. But yeah, with all the YouTube stuff going on, man, like all the crazy creators out there, I was like, this is kind of funny. That's gonna be my tagline. That'll be it. And then my disclosure is right there in the thumbnail.
Yeah. No, I mean, it works. It's not wrong. And I mean, that's the thing. It's like, if either of us were financial advisors, that actually makes it worse, not better, because then that means you're breaking the rules. Like, actually,
that's the one really crazy thing about this industry is like the more knowledge that you have,
but
yeah, like the more knowledge you have, and like the more qualifications you have, the more liable you are. It just blows my mind. I was looking at like oh, yeah, the CFP or CFA or whatever, and like different securities certifications. And as I went down that road, I was like, shoot, like the more qualified you get, the more liability you have. Like,
yeah. I mean, like I said, like
wild.
I'm finishing my finance degree, and so I'm looking at all those certifications, be like, which of these do I want to add to the gauntlet? But there are strings attached to some of them.
Yep.
and more strings depending on what company hires you as well. It's like I know we kind of played tag with this date a couple times, and I was going to career fairs at my school, and I was literally talking to, that was like one of the questions I would ask them. They were probably surprised that somebody was asking this as one of their questions about the company. But I'm like, do you guys have trading restrictions? Do you guys have trading restrictions? Whenever I was talking to companies, I was like, am I going to be restricted from trading if I join your company? It's like I kind of wondered like if how many of the other people in the room were actually asking that question when they're
Yeah.
trying to get interviews and for internships and jobs and stuff. But it was like,
Yeah.
well, I mean, I've got a portfolio, I've got a channel, I've got this thing I do on the side that
Yeah.
would suck if I kind of had to just stop doing it because I'm not allowed to talk about individual names anymore. But
Yeah. We both we got to get to 1,000 subs and get monetized. So, you know,
yeah, we're
make
both
that
on our way.
YouTube money.
Yeah, the sweet monetization dream is coming.
Oh yeah. $20 a month. Here I come.
Yeah.
All
Yeah.
right, man. Well, hey, it was great chatting with you. Everybody, thank you guys for joining. I hope you guys have a great week. And yeah, we will see you in the next one.